Welcome to the Deep Dive. This is where we sift through, mountains of information market data, company filings, even what customers and employees are actually saying, and try to boil it all down to what really matters for you. Today, we're diving deep into a company many of you probably feel you know pretty well, Oracle Corporation, ticker ORCL. Now, Oracle, for ages, has been this massive, almost unshakable presence in enterprise software, a real bedrock. But things have changed dramatically. So our mission today is to really unpack whether Oracle has genuinely transformed itself for this new era of cloud, of AI. Is it still that same old Oracle, or has it pulled off this radical reinvention? Could it be what you'd call a wonderful company, something you'd feel good about owning for, say, the next couple of decades? We're going to look hard at the quality of the business itself, how management's handled things, its financial strength, and the big one. What about the price right now? Is it worth it?
It really is a fascinating story. I mean, the sheer scale of the bet they're making on the future, it's something else. It's a company fundamentally changing its shape.
Absolutely. That's a massive question. And before we dive into the details, just a quick note for our listeners.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
Right. So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Okay, let's get into it. Pillar number 1, the business model. Let's start right there. How does Oracle actually make money these days? Especially with everyone. I mean, everyone. Talking cloud. The old model, selling licenses forever. That seems like ancient history now.
You're spot on. Oracle's business model has gone through this seismic shift, and frankly, it was a necessary one. You're right. Historically, it was all about selling those big, upfront, perpetual software licenses. But they've pivoted hard towards a recurring revenue model, subscription-based, centered on the cloud. And this isn't just, tweaking the price list. It's a total rethink of how they engage with customers, how the money flows. It's shifted from those big lumpy deals to ongoing relationships. So if you look at their fiscal year 2024 numbers, they pulled in around $53 billion in total revenue. Huge number. And it breaks down into 4 main chunks, but one really dominates. It's the strategic core. That's cloud services and license support. This piece alone is about 74% of their total revenue, and it's kind of a hybrid beast. It includes the subscriptions for their software as a service, SaaS applications.
Okay, SaaS, so that's the ready-to-use software online, right? Like their big ERP systems.
Exactly. Things like their flagship Fusion Cloud ERP that handles finance, supply chain, the whole 9 yards for big companies, and NetSuite ERP, which is more for the small and mid-sized guys. Plus, they're building out industry-specific stuff too, like a big push into healthcare lately. And this big bucket also includes their infrastructure as a service, or IaaS. That's their Oracle Cloud Infrastructure, OCI. Basically, customers renting computing power, storage, networking directly from Oracle's data centers. But here's the kicker, the part people often miss. That 74% also includes the incredibly profitable, really stable revenue they get from maintenance and support contracts on all that legacy software still running out there on customer premises.
Okay. So the support for the old stuff.
Right. And that legacy support stream is like a guaranteed cash cow. It's predictable, high margin, and it's essentially bankrolling this massive, expensive shift to the cloud. It's pretty smart, actually, a way to fund the future using the past.
That makes sense. So the old entrenched business is fueling the big bets on the new cloud business. That's clever. What about the other pieces, the smaller slices of the pie?
Yeah, exactly. That legacy cash is the engine. So the second bit, about 10% of revenue, is cloud license and on-premise license. This is that declining legacy business selling new perpetual licenses for software customers run themselves. It's shrinking, yeah, but it still brings in some lumpy cash when big companies add more on-prem stuff. Then you got hardware. That's about 6% of revenue. This isn't just selling random servers. It's mostly their engineered systems, like Exadata, that's a high-performance box specifically designed to run Oracle databases super fast. Hardware and software bundled together, plus other servers and storage. It's often part of a full-stack deal where Oracle controls everything. And finally, services. That's the last 10%. Think consulting, implementation help, training. Absolutely vital for big companies trying to roll out complex Oracle systems, especially things like massive ERP migrations to the cloud. These services help make sure the customer actually succeeds with the tech.
Okay, so it's definitely not just a simple software company anymore. It's this mixed high-growth cloud, super stable legacy support, some specialized hardware, critical services. Sounds like it gives them multiple ways to grow, but also kind of cushions the blow during this huge transition.
You nailed it. And what's really interesting is that underneath all that, the core of what Oracle does is remarkably easy to grasp, and it's something businesses will always need. Fundamentally, they provide the essential software and infrastructure for companies, for governments, to run their most critical operations. Finances, supply chains, HR, customer data. It's basically the digital nervous system for something like 95% of the Fortune 100. This isn't just nice to have software, it's woven right into how the global economy functions. And the need for this stuff isn't going away. If anything, it's growing. Managing data, automating business processes like ERP, handling customer relationships, these are permanent needs. Digital transformation is pushing it harder, and then boom, you have this explosion in AI, which needs exactly the kind of heavy-duty database and infrastructure muscle Oracle specializes in. It's been a huge, unexpected tailwind for them.
Okay, now this is where it gets really interesting for me. You mentioned moving to subscriptions. That feels like more than just a billing change. It sounds like it fundamentally changes the relationship with the customer, right? From these big, sometimes maybe tense, license deals to more of a continuous partnership. Oracle's suddenly responsible for making sure everything keeps running smoothly.
That's a critical point. Absolutely vital. In the old license world, yeah, sometimes it felt a bit adversarial, just close the deal. The subscription model forces a different dynamic. It demands a continuous partnership. Oracle is now directly on the hook for performance, uptime, security, keeping the systems up to date. It's not just shipping code, it's delivering a reliable, evolving service. And that shift towards being more customer-focused, which CEO Saffra talks about a lot, it isn't just talk. It has to happen for the model to work, because a happy cloud customer doesn't leave. They churn less. That creates predictable, high-quality, recurring revenue. It turns those one-off deals into deep operational dependency, and that strengthens their competitive position, their moat.
That makes total sense. So given how embedded they are, what makes them so hard to kick out? What's the economic moat here, that thing protecting their profits?
Oracle's moat is really formidable. It's primarily built on high switching costs.
Yeah.
And these aren't just about money. They're operational, technical, even psychological barriers. Their core stuff, the database, ERP suites like Fusion Cloud or NetSuite, these aren't just tools people use. They are deeply, deeply embedded in the critical workflows. They're the system of record.
System of record. So, like, the ultimate source of truth for that data.
Exactly. The one place you go to know exactly what happened, financially, operationally. Because of that, trying to replace these systems is just daunting, almost unthinkable for a big company. Migrating a large enterprise off Oracle ERP to, say, SAP or Workday. It's not just buying new software, it's potentially a multi-year, multi-million, maybe even billion-dollar project. And it's incredibly risky. A botched ERP rollout can literally paralyze a company. They might not be able to close their books, ship products, pay people. That risk alone is a massive deterrent, makes customers incredibly sticky.
Can you paint a picture for us, a real-world example of just how sticky that makes them?
Sure. Imagine a huge global manufacturing firm. They've been using Oracle database and ERP for, say, 15 years. Everything global financials, inventory across dozens of factories, production schedules, purchasing, it's all built on Oracle tech, probably heavily customized over the years. Tens of thousands of employees know how to use these systems. It's how they do their jobs. Now, a competitor comes knocking. SAP, Microsoft, whoever. The CIO has to think about, okay, first the sheer cost. Millions for new software, millions more for consultants. Then the operational chaos, a multi-year project just to redesign processes, customize the new stuff, migrate massive amounts of critical data perfectly. They'd probably have to run both systems in parallel for a long time. Huge complexity, huge costs. Then you've got the human side, retraining thousands of people, productivity tanks temporarily, and looming over all of it is the massive execution risk. What if the data gets corrupted? What if the system crashes during rollout? What if it just fails? We've all read the horror stories about failed ERP projects.
Wow. Okay. So when you lay it out like that, the path of least resistance is almost always just stay with Oracle, which explains how they get that leverage, that pricing power. You mentioned maybe 95% margins on support. That's because leaving is just too painful and dangerous.
Precisely. That's the moat. And what's really fascinating and maybe a bit counterintuitive is that while cloud initially looked like a threat that could shrink that moat, Oracle's response seems to be actually defending and now actively widening it.
Yeah, the first cloud moves were defensive, protect the database from AWS, from Azure. But now it's clearly offensive. They're aggressively building out OCI, their own cloud infrastructure. They're tightly integrating it with their own SaaS applications. And they're buying companies like Cerner for healthcare to create these deep, industry-specific solutions. All of that creates a more complete, more integrated Oracle ecosystem.
So it becomes even harder to leave if you're using their infrastructure and their database and their applications. Exponentially harder. The switching costs just multiply. And then there's AI. They're smartly using the AI boom as another tool to widen the moat. They're pouring billions into specialized AI data centers, offering unique setups, even custom chips for AI work. By landing these huge deals to train large language models for big AI players, they're not just getting OCI revenue. They're locking in a new generation of customers who are building their entire AI future on Oracle's foundation. And you see it in the numbers. Yeah, OCI's overall market share in IS is still small, maybe 3% or so, but in their target areas, it's working. IS revenue surged, 52% in their Q4 fiscal 25? That's faster than the big guys in that specific segment. And they still dominate the relational database market, maybe 11 to 30% share, depending on who you ask.
That brings up a massive point. What really stands out to you as proof this is working. For me, seeing that record $138 billion backlog of remaining performance obligations, RPO, that feels huge. That's actual contracts, right? Long-term commitments.
It's profoundly significant. Yeah, RPO isn't just wishful thinking. It's contracted future revenue stretching out for years. It gives them incredible visibility. It shows customers aren't just kicking the tires on Oracle Cloud. They're making serious long-term commitments. So yeah, they're dominant in legacy databases, but they're also this fast-growing challenger in IS aimed right at the high-value enterprise and AI workloads. That RPO number is like a giant vote of confidence from their biggest customers.
Okay, shifting gears a bit. Beyond the strategy docs and the financials, what about the people? How do customers really feel about Oracle? And what's it like on the inside, working there? You always hear strong opinions.
Oh, definitely strong opinions. It often comes down to this dynamic I call tolerated, not loved. So on the plus side, customers genuinely respect the products. They praise the robustness, the scalability, the sheer feature depth, the performance, the reliability, especially for critical stuff where failure isn't an option. The Oracle database is legendary for handling huge loads. The ERP suites are seen as incredibly comprehensive. People call them the industry standard. They just work, they scale. That's huge for big companies. But that respect comes with a big side of frustration. The number one complaint always is cost. Expensive. Not just the sticker price, but the total cost to own and run it, implementation, customization, management. People often say it's overly complex, you need armies of expensive consultants. The user interface, especially on older stuff, gets called clunky, sluggish, not intuitive compared to newer cloud stuff. And customer support often gets slammed as bureaucratic, slow, unhelpful.
That's fascinating. So it's expensive, complex, maybe annoying to use. Why do these huge smart companies stick with it? It seems like a contradiction.
That's the power of the moat right there. That's the deeper analysis. They stay because the functional power, the reliability, and how deeply woven Oracle is into their operations, it outweighs the pain points. The perceived pain, cost, and risk of switching are just seen as far, far greater than the pain of staying. It's a pragmatic choice, driven by necessity, not love. And that gives Oracle enormous pricing power. Now, Oracle knows this is a vulnerability long term. That whole cloud pivot, the talk about customer success, it's partly about mitigating this risk. They need the new cloud stuff to be easier, better, more cost effective, or eventually customers will find alternatives. And from the employee side, it's a real mixed bag. Typical mature tech giant stuff, especially one going through a big change. Positives. People mention decent work-life balance sometimes, the prestige, the global resources. If you're in a hot team like OCI or AI, the work can be really cutting edge, really engaging. Negatives. Feeling like a small cog in a giant machine. Lots of bureaucracy. Career progression can be slow unless you're in a high-demand spot. Compensation might not keep up with smaller, faster companies. Sometimes gripes about slow internal tech or management feeling a bit disconnected. For an investor thinking long-term, there's a cultural question there. Can this huge ship turn quickly enough? Does it have the agility to outmaneuver nimbler competitors in these super fast markets like cloud and AI? Culture matters.
That gives us a really solid feel for the operational reality. Okay, let's pivot now to the leadership, the folks making the decisions. What's their style, especially when it comes to spending money, allocating capital?
Oracle's leadership is known for, well, deep experience and incredible tenure. Saffra, the CEO since 2014. She's been at Oracle since 1999. She understands this company inside and out like few others could. Her philosophy seems to be relentless execution, really sharp financial discipline, but combined with this incredibly bold, aggressive push to win in cloud and AI. She famously said something like, "Changing slowly can be fatal." That signals a willingness to take big, calculated risks. You pair that execution focus with Larry Ellison's vision. He's still very involved as chairman and CTO, driving the technology, and you get this potent mix. Ambition meets discipline. They're not afraid to make huge long-term bets.
Right, ambition and discipline. How is that translated into actual capital allocation decisions? Where are they putting the money? This is where the strategy really hits the road financially.
Well, their capital allocation has gone through one of the most radical shifts you'll see in any mega cap tech company. For years, Oracle was basically a cash machine spitting out money via huge share buybacks. They've slammed the brakes on that and pivoted almost 180 degrees. Now it's about aggressively reinvesting pretty much every dollar they can back into the business to fuel growth. The most glaring example is capital expenditures CAPEX. It used to be, a couple billion a year, peanuts for a company this size. Then it just exploded. From $2.1 billion in fiscal 21 to, get this, over $21 billion in the trailing 12 months ending May 2025.
Wow, a tenfold increase. Where's all that going?
Data centers. A massive global build-out of hyperscale data centers. You absolutely have to do this if you want to compete seriously in IS and AI training against Amazon, Microsoft, Google. It's the table stakes. It's the physical foundation for OCI and their AI ambitions. Research and development R&D that's also stayed strong and growing. $8.9 billion in fiscal 24. That's focused on making OCI better, adding AI features everywhere, and crucially, modernizing Cerner, that big healthcare acquisition. And speaking of acquisitions, M&A has always been part of Oracle's DNA. But the $28.3 billion all-cash deal for Cerner in June 2022 was enormous, strategically huge. The idea was clear. Use Oracle's infrastructure and tech know-how to modernize Cerner's electronic health record systems, move them to OCI, and build this dominant position in healthcare tech, maybe even an AI-powered health data platform down the line, a massive bet on a specific industry vertical.
Okay, so if all the money's going to CAPEX, R&D, and giant acquisitions like Cerner, what happened to the fire hose of cash that used to go to shareholders via buybacks?
It slowed to a trickle. Seriously. Oracle used to be one of the biggest buyers of its own stock. Double-digit buyback yields sometimes between 2018 and 2021. That's practically stopped. Cash is being hoarded for reinvestment. They have kept paying and increasing their dividend, though. For 11 years straight now, it's a nod to shareholders, shows some confidence. But the yield is tiny, less than 1%, and the payout ratio is low, like 38-39%. It's clearly way down the priority list compared to funding the growth engine.
So what's the verdict on this strategy? All this spending, this massive shift, is it rational? Does it make sense long term? Or is it just a huge, risky gamble? Feels like they've pushed all their chips in.
My assessment, it's highly rational, even if it's incredibly aggressive. Look, the leadership saw the threat. The public cloud giants were an existential threat to the old Oracle model. They didn't just react defensively. They made a decisive, all-in bet to carve out a new growth engine with OCI and AI. It's not just growth for growth's sake. The Cerner deal, yeah, it hurts financial short-term. It's a tough integration, but it fits the logic. Build deep industry-specific advantages on top of your own infrastructure. And that dramatic shift away from buybacks, which mostly just juice the EPS number towards massive internal investment, that's classic owner-oriented thinking. They're doing the hard work now to build future value, even if it makes the current numbers look strained. They're backing their strategy with serious cash.
Okay, but this all-in strategy, all this spending, it must be putting a strain on their finances, right? How is the Oracle financial fortress holding up under all this pressure?
Yeah, fortress is a good word for the old Oracle. High margins, predictable profits, tons of free cash flow, a real financial powerhouse. But this pivot, this transformation, it has introduced significant and importantly intentional strain. Sure, top-line revenue growth has kicked up again, 6% in fiscal 24, then 8.4% trailing 12 months. That's good. But the quality of those earnings has changed. That massive CAPEX surge, it crushed free cash flow. And Cerner, while strategic, definitely dragged down growth and margins initially because it needed investment. So the fortress is still standing fundamentally, but it's like it's undergoing this huge, expensive, messy renovation right now. It's a construction zone.
Let's dig into the numbers that show that strain. What are the key ratios we should be looking at?
Okay, number one for me is return on invested capital, ROIC. Think of it like your return on investment. For every dollar Oracle puts into the business, how much profit does it get back? Historically, Oracle's ROIC was great, mid-teens consistently, a sign of a really high-quality, moated business, but it's been trending down from 15-16% in fiscal 2021 down to more like 11-14% recently. Why? Well, the denominator, the invested capital, ballooned because of the Cerner debt and all that CAPEX. The numerator, the profit, NOPAT net operating profit after tax, hasn't kept pace yet. Watching where ROIC goes from here is probably the single most critical financial indicator of whether this whole massive bet actually creates value in the long run or destroys it.
Okay, ROIC is down because of the investment. What about cash? They used to be a cash machine.
Right. Let's look at free cash flow, or FCF conversion. Historically, yeah, cash machine. A big chunk of their net income turned right into spendable cash. That has basically collapsed recently. In fiscal 24, operating cash flow was decent, $18.7 billion. CAPEX was $6.9 billion, so free cash flow was about $11.8 billion. Respectable. But look at the very latest trailing 12 months. CAPEX surged over $21 billion. That pushed trailing 12-month free cash flow negative. So right now, they're not generating cash for owners after investments. They're plowing every penny of operating cash and then some back into building out the cloud infrastructure. Huge shift. Direct result of the strategy.
And debt. They took on a lot for Cerner, right?
They did. Let's look at balance sheet strength, specifically net debt to EBITDA. That ratio jumped from a comfortable 2.0x in fiscal 21 up to 4.1x right after Cerner closed in fiscal 23. It settled back a bit, maybe 3.7x to 3.8x recently. But that increase got noticed. S&P put a negative outlook on their debt. They're worried about the FCF strain, and the risk leverage stays above their downgrade level, which is around 3.5x. Now, Oracle can probably handle this debt level given its size and recurring revenue, but it definitely reduces their financial cushion, their margin for error, less wiggle room than before.
Okay, so we've covered the business, the moat, the leadership, the financial pressures. Now, the $1 million or maybe $1 trillion question. What does the market think? And what's the outlook for the stock price? Is this transformation already priced in or maybe overpriced?
Good question. Let's look at valuation, say, mid-2025. The trailing price to earnings ratio, PE, is way up there, around 53x to 55x. That's telling you the market expects serious earnings growth ahead, the price to free cash flow ratio. Kind of meaningless right now, actually negative, because FCF is negative due to that massive CAPEX. Now, compare that PE of 54x to Oracle's own history. Its 5-year average was more like 28x to 31x. It was even down around 16x back in fiscal 2020, so the multiple has just exploded upwards. That signals a huge change in how the market sees the company. Our judgment. This looks like a demanding entry point. The market isn't valuing Oracle like the stable, cash-returning legacy company anymore. No way. It's pricing it like a high-growth AI superstar. It's baking in really optimistic assumptions. It assumes they execute flawlessly, that OCI delivers huge high-margin growth, that Cerner integrates perfectly, that the whole $138 billion RPO turns into profit smoothly. There seems to be very, very little margin of safety baked into this price for anything to go wrong. Buying now is basically betting the most optimistic scenario plays out perfectly.
Okay, so if the valuation is that demanding, what's the main engine driving that optimism? What's the big growth story? And conversely, what are the biggest long-term risks? Not just a bad quarter, but things that could really break the investment case permanently.
The number one driver, hands down, for growth and optimism is OCI, Oracle Cloud Infrastructure, and specifically AI workloads. The demand for training and running these huge large language models, LLMs, is just off the charts, and Oracle is positioning itself as a key provider. Management's been crystal clear about this. They signed the biggest deals in Oracle history in late fiscal 24, almost all AI related. That's what pumped the RPO up to that record $138 billion. Saffra Catz is even talking about either way HIOS growth potentially hitting over 70% in fiscal 26. They are betting the farm on being essential plumbing for the AI revolution. But yeah, there are real long-term risks that could genuinely cause permanent damage. These aren't just market jitters. First, execution and integration risk. What Oracle is trying to pull off is incredibly complex, building a global network of cutting-edge data centers while trying to digest and completely rebuild their biggest acquisition ever, Cerner, moving its core to the cloud. That's a monumental task. Things could go wrong, cost overruns on data centers. Delays launching that new AI-powered EHR system for Cerner, it's supposed to be 2025. Or maybe they just can't turn that huge RPO backlog into profitable revenue fast enough. Any of those could really hurt earnings and strain the balance sheet. Second, intensifying hyperscaler competition. Let's be clear. They're going head-to-head with Amazon AWS, Microsoft Azure, Google Cloud. These guys are giants, hugely capitalized, dominant market share, deep enterprise relationships, and they're also investing billions in AI. There's a real risk of a brutal price war in cloud infrastructure, or that the big guys just outspend or out-innovate Oracle. That could squash Oracle's margins, cap their growth, and make all that massive CAPEX look like a really low return investment. And third, the balance sheet and financial risk we touched on. Negative FCF, higher debt. It just reduces their resilience. If the revenue from these big bets doesn't show up as quickly or as profitably as hoped, they could get squeezed. A credit downgrade increases borrowing costs, might force cuts to investment or dividends. It could become a negative cycle.
That's a clear picture of the risks. Okay, let's try some second-level thinking. We know the basic bull story. But how does the market consensus see Oracle right now? And what's the deeper, maybe contrarian angle we should consider? What's the market maybe missing?
Well, the prevailing market story, the consensus has definitely shifted. The narrative is Oracle did it. They successfully ditched the legacy label and became a real AI and cloud growth story. People point to the OCI growth numbers, that massive $138 billion RPO, and see guaranteed future revenue. The market seems willing to look past the current financial pain, the negative FCF, the crazy CAPEX, seeing it as just necessary investment for future dominance. You see this reflected in analyst upgrades, higher price targets. That's the mainstream view. Our second level take, though, is that the market might be significantly underestimating the potential for a permanent degradation in Oracle's fundamental business quality, specifically as measured by return on invested capital, ROIC. The market seems to be thinking RPO growth leads to revenue growth, leads to higher stock price. Simple. Too simple, maybe. Think about old Oracle versus new Oracle. Old Oracle, financially beautiful, capital light, super high margins, gushing free cash flow, great ROIC. New Oracle, massively capital intensive, currently lower margin, lower ROIC. Choose through cash for CAPEX. The market seems to just assume this new heavy spending model will eventually produce returns on capital as good as or better than the old model. That's the implicit bet baked into the high valuation. Our contrarian question is, what if cloud infrastructure is just fundamentally a lower quality business than high margin software licensing? It's way more competitive, needs constant huge investment, assets depreciate fast. We think there's a real risk the market is ignoring. Oracle might be trading a fantastic high ROIC business for a much bigger but permanently lower ROIC business. Even if revenue skyrockets, if the returns on all that new capital are just mediocre, they might actually be destroying shareholder value long term. The current valuation doesn't seem to price in that risk of permanently lower capital efficiency at all.
That's a really sharp counter-argument. Okay, let's try and pull this all together. Synthesize the arguments. What's the strongest bull case for owning Oracle today? Why would someone buy it?
Okay, the bull case. First, durable widening moat. Those switching costs are real, incredibly high. And Oracle's strategy with OCI and industry clouds like Cerner seems to be actively defending and even widening that moat for the cloud era, making it stickier than ever. Second, massive locked-in growth pipeline fueled by AI. That $138 billion RPO gives incredible visibility into future growth, driven by cloud migrations and huge AI training deals. OCI looks like a key beneficiary of the whole AI revolution. These are multi-year commitments. Third, proven, rational, owner-oriented leadership. Catz and Ellison have shown they'll make tough, bold, long-term bets. Shifting from buybacks to massive reinvestment shows they're focused on building real enterprise value, not just short-term financial engineering. And fourth, accelerating cloud momentum and multi-cloud validation. OCI's growth is outpacing rivals in key segments. They're winning big deals. And those partnerships, putting Oracle databases inside Azure and Google Cloud, that validates their core tech and expands their reach.
Okay, that's the bull case. Now flip it. What's the equally strong bear case? The compelling reasons not to own Oracle right now.
All right, the bear case. First, demanding valuation, no margin of safety. The stock's expensive compared to its history. It prices in perfection, years of flawless execution, no room for error. Second, unprecedented execution risk. They're juggling two massive, complex transformations at once. The global OCI build-out and the huge Cerner integration. The risk of fumbling one or both is significant. Few companies have ever tried something this ambitious simultaneously. Third, strained financial fortress. The strategy has weakened their historical financial strength. Negative FCF, higher debt, that S&P negative outlook, it reduces their flexibility, their ability to handle shocks. And fourth, formidable, entrenched competition. They're taking on AWS, Microsoft, Google head-on. These guys are bigger, richer market leaders. Risk of getting outspent, out-innovated, or dragged into margin-killing price wars is very real.
All right, let's really push the thesis, the red team challenge. What's the single most compelling argument for why buying Oracle today could be a major long-term mistake? Paint the nightmare scenario.
The red team challenge flips the bull case on its head. What if the new Oracle is just a fundamentally lower quality, less profitable business than the old Oracle permanently? Maybe AI infrastructure, despite all the hype, becomes a low margin commodity business. AWS and Azure use their scale to crush prices. Oracle wins revenue, sure, boost that RPO, but the margins are razor thin or even negative after you account for the massive depreciation and constant reinvestment needed. All that growth actually destroys value. At the same time, maybe that big Cerner bet, the key test of their industry cloud strategy, goes sour. Integration is harder, costlier than expected. That fancy new AI-powered EHR system flops or gets delayed indefinitely. It becomes a financial black hole and shatters the narrative about building moats in new industries. Where does growth come from then? So the nightmare scenario looks like this. Between, say, 2023 and 2028, Oracle spends $100 billion, maybe more, on CAPEX and acquisitions. Revenue grows, yeah, but it's low-margin, capital-hungry growth. ROIC, already down around 11%, never recovers. It gets stuck in the single digits, maybe even below their cost of capital. They end up with this massive, depreciating asset base and a pile of debt. Eventually, the market wakes up, realizes the growth wasn't profitable, wasn't value accretive. The stock gets violently re-rated, loses its fancy AI multiple, gets valued like a low-return industrial tech company. The stock goes nowhere down for a decade. The business is left permanently less profitable, more fragile. Buying today would have been buying at peak hype, peak valuation right before the fall.
That's definitely a sobering scenario. Oracle is, without a doubt, performing this incredible balancing act, a truly bold transformation, aiming right for the heart of the AI revolution. But it's clear it's coming at a huge cost to their old financial profile, especially free cash flow, returns on capital. They are absolutely investing billions to build future value, to secure their spot for the next decade or more. But the critical question for you, listening right now, is whether this new, super capital-intensive business can ever deliver the kind of high returns on capital that made the old Oracle so profitable for so long. So, as you think about everything we've discussed today, here's a final thought to chew on. Is Oracle genuinely building the next digital nervous system for the AI age, set to dominate for decades? Or are they spending hundreds of billions just to become the world's most sophisticated but ultimately low-margin server landlord in a brutal, commoditizing cloud market? Which story resonates more with you? Something to think about. We encourage you to keep doing your own deep dives. Thanks for joining us on The Deep Dive.